All right, good to go. Well, thank you so much for joining us today. Today we are going to talk about everybody's favorite startup subject. Just kidding, but definitely one that you need to keep abreast of, especially as things start to go well. Understanding taxes, especially taxes as it relates to Delaware C Corps, which, if you're a startup, is probably the entity type you have chosen. If it is not, come talk to Ryan and I, and we'll help you out with Gus Launch to get you set up right for investment. Very happy today to be joined by Bert Wilson from our partners at KMK. They are startup tax specialists, venture tax specialists, personal tax specialists. They do it all. They are wonderful. They have a wonderful reputation. Everybody we send over there comes back with rave reviews. And today he is going to walk us through at a high level what you should be looking for, what you should be looking out for as you think about getting your taxes done this year, and what you can be looking toward as you kind of tax plan into the next year. We'll go through this. We are recording it. We will send it out after the fact, along with some information about KMK. If you do have questions, feel free to plop them in the Q&A and chat as we go, and we should have a little bit of time to get to all of those at the end. So Bert, take it away. Thanks for being here.
Great, thank you. Welcome everybody, and welcome to Understanding Early Stage Taxes for C Corporations. So as Peter introduced me, I'm Bert Wilson, and I am a U.S. representative and the Client Success Manager for KMK. And my role is just to check in with all of our clients periodically, just to make sure we're doing a good job for you, look for any areas of improvement, see what we could be doing better. And my qualifications, I am a CPA and I live in Colorado. So the different types of taxes and compliances that we're going to review today include federal income tax, state income tax, the Delaware franchise tax, sales tax, excise, and then the FinCEN BOI reporting. To start with, if you're working with Gust, you already know the benefits of a C corporation and the things that are there. But some of the benefits, just to kind of reiterate where they go, is corporations are treated as separate persons legally. So it's a separate entity. It maintains and shields the owners from any type of personal liability. Investors often prefer using the corporate structure for funding because there's usually more options as far as liquidity, exits, and exits from other foreign forms of formation structures like LLCs or partnerships. The tax is calculated separately from the individual level, so it makes it simpler for investors to manage their personal taxes. Also, many accelerator programs often require a C Corp structure for admission into their programs. Some of the corporation basics. Corporations are owned by shareholders and they have to be managed with a formal business management type structure. In order to contract on behalf of the corporation must have officers like president, secretary, treasurer. Minutes need to be kept for the corporation at a minimum on an annual meeting, with minutes to that annual meeting is the minimum requirement, even for a single owner corporation. Expenses. It's very important not to commingle funds. So personal expenses should never be paid for out of the corporation. Commingling of funds between your personal expenses and the business expenses can cause you to lose your liability protection. Finally, profits. Corporations should be entered into with the idea of earning a profit. A corporation that has high gross income and then zero net revenue are often audit targets by the IRS. So on to federal income tax basics. A tax return is filed to determine how much tax an individual or a company owes to the government in any given year. The taxable income is gross income minus any deductions or exemptions that are allowed in that tax year by current U.S. tax law. Tax in the U.S. is owed on the income earned. Let me repeat that. Tax in the U.S. is owed when the income is earned. So it's important to make estimated quarterly payments so that you don't have late payment penalties by paying your estimated tax amount at the very, very end of the year. Also, you can elect to be taxed on a fiscal year instead of a calendar year. However, if you want to have a fiscal year filing, that should be made in the first year that you're a corporation. Otherwise, it's difficult and expensive to change that process. Corporate income tax. U.S. corporations are required to report and pay taxes on their worldwide taxable income each year. All domestic corporations must file an income tax return whether or not they have taxable income. You can see this on your SS4 when you get a confirmation from the IRS. A lot of times people say, well, I didn't have any activity this year, so I don't need to file a tax return. However, when you get your confirmation from the IRS of your SS4 for your EIN filing, and it says you've been approved to file Form 1120 and we're expecting one for tax year 2024, they're expecting to see a tax return or you're going to get a notice from the IRS. The Tax Cuts and Job Act replaced the graduated corporate tax with a flat rate of 21% on all corporate taxes or all corporate income. Generally, a C corporation must file its income tax return by the 15th day of the fourth month after the end of its tax year. So for a calendar year taxpayer, that would be a due date of April 15th. For any of those corporations or businesses that have foreign investments or foreign assets, there's additional filing requirements that may be required. Form 5471 is required if a corporation owns 10% or more of the total combined voting power of a foreign corporation. Form 5471 is filed as an attachment to your 1120 tax return and must be filed by the due date. Failure to file Form 5471 can be assessed a penalty of $10,000. Also, if you're filing Form 5471, you likely have bank accounts and assets, so there's additional FBAR reporting that's required. So that would be Form 8938 or the FinCEN Form 114 to report your foreign bank accounts and foreign assets. Another potential filing requirement is Form 5472. So if you have foreign investors that own more than 25% of your U.S. corporation, this is an additional filing requirement for you. And it must be filed by any reportable transaction is what's reported on the Form 5471. And examples of reportable transactions are sales of inventory, rents, royalties, commissions, loans, etc., by a foreign investor. And this is another one that has a stiff filing penalty if it's not filed by the due date. If not filed by the due date, the IRS will send a $25,000 penalty assessment letter. S-Corp elections is another possibility. And although there are some tax advantages to an S-Corp, there are also some difficulties with an S-Corp. I'll kind of throw that down here as we get further down. But C-Corps create sort of a double taxation situation because the corporation is taxed and then the individuals are also taxed when dividends are paid. Corporations can elect to be treated as an S-Corp. And in order to be treated as an S-Corp, you must file that election within 75 days of the calendar year or of the 75 days of the date that the corporation is formed or 75 days of the calendar year each tax year. You have an option of choosing a S-Corp election. And S-Corp would still need to file an annual return. However, it wouldn't pay its own taxes. Instead, the income from an S-Corp is reported to shareholders directly on a K-1, and they report it on their personal tax return. And there can be some advantages of an S-Corp, but if you're looking for investors, S-Corps are not the best choice because S-Corps can only be owned by individuals. So no foreign investor and no entity can have ownership in an S-Corp. Also, it can only have one class of stock, so you can't have preferred and various classes of stock in an S corporation. Another thing that you may want to be aware of is options, so incentive stock options. There's an option for you to make an 83B election. So corporate stock that's paid to founders, employees on a vesting arrangement is generally treated as income when it's received, and that's when it's vested. However, rather than waiting to vest, an election can be made, an 83B election can be made to tax the income on the date of receiving the option instead of the date that it's vested. And this can have a big advantage because as a business grows, the shares are worth more over time. And so you can pay a much lower tax rate today, potentially, than in the future when you vest. However, one downside of a of the 83B election is if you never do vest in the shares, you can't go back and claim a deduction for the income that you paid on those options with the 83B election. Also, one other thing too is one other thing to note is a large percentage of unvested shares can create a high Delaware franchise tax. We'll kind of cover that in a little bit on the franchise tax section. Here's one that many of you are probably well aware of over the last couple of years is the changes in Section 174. It had a change in 2022. Many people expected Congress to act and to push this back and to not enact it. But the ability to immediately expense research and development expenses was expired after 2021. And starting in tax year 2022, all R&E expenditures can no longer be expensed immediately, and instead they have to be amortized over 5 years. Actually amortized over 15 years if it's foreign expenses. Also, the depreciation on equipment is treated as a Section 174 expenditure and capitalized as well. And software development was specifically included in this. So R&D expenditures for software development, again, has to be capitalized. And finally, a mid-year convention is required. So even though it's spread over 5 years, which would be 20% of the expenditure, since it's a mid-year convention, in the first year, you can only claim 10% of those expenses and then 20% in the next year. And this hit software businesses particularly hard because many software engineers, you can no longer pay, you pay them their salary and you can no longer expense it in the first year. And what this can do is, here's a quick chart kind of showing the way it was. During 2021, you could immediately write it off. So you had $1 million in revenue, you had $1 million in software engineering costs. They offset and you had zero profit and zero taxes due. Starting in 2022, again, if you had $1 million in revenue and $1 million in software engineering costs, you could only write off 10% of that million in that first year. So that's a $900,000 profit and $189,000 tax burden in that year. And then in year two, you could write off you had the 10% from the first year, 20% in the next years, and you end up with $147,000 in taxes. So instead of having zero income, zero taxes due, you're paying $189,000 in the first year, $147,000 in the second year. So hopefully this is one of those things that will be reinstituted and no longer required to be capitalized. But so far it hasn't happened. So we're still waiting. So on to R&D tax credits. So you have the R&D expenditures, but you also have R&D tax credits. And there were changes to the R&D tax credits as well. So R&D credit, qualifying R&D costs that are spent in the U.S., you can write off roughly 20% of those expenditures directly against payroll taxes. And they have bumped up that limit to $500,000. So that's $250,000 in Social Security and $250,000 in Medicare taxes that you can directly write off with an R&D tax credit. However, you used to be able to kind of wait. You could kind of claim these credits, and you could do the studies if you happen to get audited. But nowadays, all that due diligence has to be done beforehand. So it's important to have somebody credible doing the due diligence, performing the tax filings, and calculating the proper R&D tax credit. And despite bipartisan support for legislation and amendments to revert back to the previous expensing, no changes have been enacted to date on R&D. So should you still be claiming R&D tax credits? There is litigation risk that's been increased of R&D tax credits because there's a lot of mills out there that sort of unethically create the amounts of R&D tax credits that you can expense because they're charging you fees based on the amount that you receive back in a tax credit, and they're sort of playing the audit lottery. However, with the IRS's new 87,000 agents and a promise not to affect individuals, that means that there's more audits to businesses. And so it can't, so it is a bit of a liability or potential litigation risk. However, this is still one of the credits that can immediately benefit startups. And it can increase with the increase of the payroll offset up to $500,000, it makes the credit even more valuable than ever. However, as I mentioned, it's really important to use someone reputable to prepare the Form 6765. And 6765 is the form that claims these credits and is filed with your tax return. And by the way, once approved, back to this one just briefly, once approved by the IRS, so you file the Form 6765 with your tax return. Once the IRS approves it, then you can now use those credits to offset Social Security and Medicare taxes that you're paying to the IRS. That's where the immediate benefit comes in. So FinCEN BOI reporting. This was a huge topic of conversation, still is, because there were substantial penalties that were going to be put in place if you did not file your FinCEN beneficial ownership report by January 1st. However, on December 3rd, it got repealed in the courts. On December 6th, it got put back, 16th, it got put back. The requirement was reinstituted with the filing date of January 13th. They gave you a little bit longer extension. But then on January 26th, they dropped it again. So it's still, so right now, there is no requirement for a BOI report. The federal courts put an injunction on it until it actually gets litigated. So so currently there's no filing required, but voluntary filing is always allowed. And if you don't want to keep up with the news and watch, you may as well, if you have nothing to hide, go ahead and file your BOI report, because at some point it may become a requirement again. And then who knows what that deadline is going to be. We're anticipating probably they'll probably extend the deadline by 2 weeks after it's decided is what we're anticipating. But right now it's entirely voluntary. And it's actually quite a simple process. Oops. It's quite a simple process. This is what it looks like. This is the site that you go to for the BOI beneficial ownership reporting. It's really easy. It takes only about 15, 20 minutes to file. However, you do have to share your ownership information. You have to provide a copy of any owner with 25% or more ownership in the business. You have to give a copy of their driver's license or passport and upload it into the FinCEN files. So that's why a lot of people weren't too happy about this. But like I said, if you don't want to worry about the potential for penalties, if and when this is ever reinstituted, you can go ahead and file now. They're still taking voluntary filings. So state income taxes. Other than federal income tax, there are 44 states that levy a corporate income tax. Each state has different rules on whether an out-of-state business is required to file in that state, based on their income structure and the income generated in the particular states. Generally, a corporation must have nexus in a state before it's required to file in that state. And once you have nexus, you're registering with the Secretary of State. And if you register with the Secretary of State, that kind of creates the filing requirement as well. But nexus is defined as some definitive link or minimum connection between the corporation and the state that would be sufficient for it to impose the tax on the corporation. Some of the factors that establish a nexus with a particular state is a physical presence in the state, employees in the state, and this became a huge issue with the COVID issue, with everybody working remotely. Now you may have employees in multiple states, and you weren't anticipating that. But if you're paying employees in multiple states, those employees create nexus for you in those various states. And then there's a new concept called economic nexus. And so sales activities beyond a certain threshold creates a nexus for you in the various states too. So here's the other one we were talking about a moment ago, Delaware franchise tax. So if you are working with Gust, you're likely a Delaware C corporation. And Delaware requires an annual franchise tax and an annual report and franchise tax payment every year by March 1st of that year. And so if you've never filed this form before, don't be scared when you first log into the site and see it, because when you first put in your file number and you start the process, it's going to give you an estimated franchise tax amount of somewhere between $20,000 and $70,000 as your fee for the year. However, once you start entering the information of shares issued, shares authorized, shares issued, the par value, and then your net assets, and then you hit recalculate, the typical fee is somewhere between $400 and $500, and that's your annual fee with the Delaware franchise tax. This is not part of your income tax return. So if you've engaged someone to file your income tax return, keep in mind that this is a separate filing. This is like your annual report with the Secretary of State where you reside. And one other thing too is make sure that you file on time, because if you miss that March 1st deadline, the penalties start kicking in, and the penalties typically start at around $200. And so it's important to file on time to avoid the penalties and the interest. Sales tax. So this is where that economic nexus concept comes in. The South Dakota versus Wayfair was a landmark decision which created the opportunity for states to force you to collect and remit sales tax. And rather than just physical nexus, now they have a concept called economic nexus. And that economic nexus for most states is typically around $100,000 in sales, or 200 individual transactions in that state. And that would create an economic nexus for you. And once you have economic nexus, you need to file with that state, and you need to begin collecting and remitting sales tax in that state. Service income. So some states, businesses that sell services across multiple states need to be aware that some states tax service income and some do not. And so if you are a service type company, beware that Delaware, Hawaii, New Mexico, South Dakota tax most service sales. Other states like Washington, Texas, and Minnesota are expanding their taxability of these services. So you may be subject to collect, even though like a state like I live in Colorado, where services are not subject to sales tax. But I need to be aware that if I'm selling services in some of these other states, that I need to collect or remit that sales tax. Drop shipping. So if you're selling through online marketplaces, most of those sales are taxable in the various states if you meet economic nexus. However, it doesn't mean that you need to register and pay taxes in all of those states. A lot of the marketplace facilitators like Amazon will collect and remit the sales tax on their own. And then also, if you're making direct sales through your website and collecting it through Shopify, Stripe, something like that, again, you have that economic nexus concept before you need to start charging and remitting sales tax. Finally, there are services out there that will help you with that. The software like Avalara or TaxJar that you can connect to your website that will automatically calculate the correct sales tax in the various states. And you could even hire, Avalara will even take care of the filing of those sales tax returns for you, should you choose to use them for that. Then comes software. So a SaaS type company, software is a real gray area, because it can be argued that it's a digital product or it's a service sale and not subject to sales tax. But you need to carefully watch that, because some of these states, every state is different the way they tax software and or SaaS income. So pay particular attention and take a look at the laws of the various states. Now, independent contractors versus employees. When you're starting out, you probably don't want to start off with a lot of high cost employees. You may want to use independent contractors to begin with. Employees you are going to require payroll tax filings, collecting payroll tax, remitting it, etc. And the filing requirements are different for independent contractors versus employees. As an independent contractor, you're paying them and they're responsible for the taxes on their individual tax return. As an employee, you are responsible for withholding income taxes and for paying half of the FICA taxes. Employees are generally those who receive specific direction from the employer about when, where, and how to do their job. Independent contractors are defined as someone who's in charge of themselves. They are responsible for how and when to get the job done. Typically, independent contractors provide their own tools and their own equipment when they're on the job. An employer normally controls more details of when, where, and how an employee performs their work if it's an employee. States would like, of course, to see all workers classified as employees because many states have special leave processes. If they classify them as employees, you're going to have to pay the unemployment tax on them. Again, the states would prefer to collect the taxes, and they would like to see the employee. They like to see the workers as employees, not as independent contractors. Most states have documentation rules designating workers as an independent contractor. So if you want to pay someone as an independent contractor, make sure you follow those rules. For an employee must withhold the income tax and pay the FICA tax and remit it to the IRS. State and local governments also require withholdings of their wage income and unemployment taxes. Having employees triggers other compliance aspects as well. That's what I was pointing out, as family leave, equally offering benefits for both health plans and employer pension plans. And then if you are withholding taxes, the trust fund recovery penalties are some of the most harsh of all IRS penalties. So when you withhold the taxes from the employee's payroll, make sure you submit those taxes and pay them always on time to the IRS. If you're paying someone as an independent contractor, you need to provide Form 1099-NEC, and those are due by January 31st, so only a week from now. So if you have been paying contractors, make sure you get your 1099s out in the next week. It's due by January 31st. And the 1099 has to be sent to any independent contractor for which you've paid $600 or more in the given year, or in 2024. It's a good practice to make sure you have Form W-9 obtained from every independent contractor when you hire them, when you bring them on as a worker, because that way you'll have the information you need to provide that 1099. If a worker refuses to provide a W-9, you may have to withhold taxes and submit that as well. Finally, there's a Form W-8, which is used to collect information on foreign workers, so non-US workers, to prove that they are not US persons. A W-8 does not, if you have a foreign contractor, you do not need to issue a 1099, but you do have to have the W-8 on file. So if anyone ever comes and checks and looks into it, you have to have this W-8 to prove that they are not a US worker. Also, there are state reporting requirements that are starting to increase. California's leading the charge. And California companies must withhold 7% on payments made to non-resident contractors, so people outside of California. If it's California source income and it exceeds $1,500 a calendar year, 7% of the amounts paid would need to be withheld from those workers, from those contractors. And of course, states prefer workers to be designated as employees. And so in order to ensure that you can keep them listed as an independent contractor, a good rule of thumb is to make sure that all independent contractors provide you with a bill for their services. This demonstrates that they are a separate entity, that they have that they're controlling their own work as far as who, when, where, what that they're doing, and that they're billing you for the company for it or for those services. It just assists you if you ever get audited, because if you get audited and you don't have some of this information on hand, the state is going to designate those contractors as employees, and it's going to hit you with taxes, back taxes. 1099K updates. So this is another one that I would love to see it changed, because there are a lot of transactions out there with, credit card payment processors, Venmo, a lot of these things that where money's going back and forth, and it's not income. It's just reimbursing each other for different services. But a 1099K is an IRS tax form to report payments processed through payment cards, third-party network transactions, like I say, like Venmo, Zelle, a variety of other services. And the IRS is phasing in. It formerly used to be $20,000 was the threshold. If it was under $20,000 that was transferred to you through these other services, there was no reporting requirement. For 2023, they went from it was 20,000 and 200 reportable transactions was the threshold. So it had to be 20,000 and 200. For 2024, so for this year, that threshold was dropped down to $5,000 with no minimum number of transactions. So anyone that you paid $5,000 or more would need to be reported on a 1099K. And then for 2025, that threshold's dropping down to 2,500. And then in 2026, it gets down to where the IRS wants it, which is the 600 threshold. And that's the current law. And so that's the way it's going to be slowly phased in. And a 1099K, again, if you receive a 1099K, make sure you report that income. It's possible you have to put it on a Schedule C of your individual tax return, but and then offset it with what it was used for, because it's likely not income. It's basically just reimbursements or money going back and forth between you and could be even another entity. But you would want to report that income and then offset it with the expense. Just say it's an expense as well, the same amount. So some of the tax changes for 2024 tax year that we're currently in season. So the threshold for the top tax rate for married filing jointly has been increased to $731,200 for 2024. The standard deduction is now up to $29,200. They've increased some of the retirement account limits. So the contribution limits have been increased for 2024. Bonus depreciation, where you used to be able to write off an asset 100% with Section 179 depreciation, has been decreased to 80%. So down from 100% to 80% depreciation effective in 2024. The refundable tax credit on your individual return has been increased to $1,900. There was the implementation of a 15% global minimum tax rate. And then also several states like Colorado, where I live, they've gotten rid of the graduated tax rates for businesses. They've gone to just a flat rate. So it went from, I think it was 4% and 4.5% is where the graduated rates went to here in Colorado. It's just 4% flat rate across the board for everybody in Colorado now. So here's some changes that may be coming in 2025 and 2026. So as everybody's aware, this is a huge topic of conversation, but the Tax Cut and Job Act, which reduced all the various tax rates, expires after 2025, so at the end of this year. So if action's not taken before the end of this year, the Tax Cut and Job Act expires and everybody's tax rates go back up. So that top tax rate of 37% goes back up to 39.5%, and every tax bracket goes up. So of course, that's something that we're hoping that they're going to take care of this year, is to reenact and hopefully make those tax cuts permanent. Another topic of discussion is the SALT deductions, the state and local income tax deduction. Currently, there's a cap of $10,000. It's expected to be modified and expected to go to at least 20,000. I know some of the blue states are really pushing for 100,000 or no limit on the salt tax, but that's one of the things to watch for this year. Something new that did go into effect is Social Security benefits for public sector workers have been restored. So, and the windfall elimination provision has been repealed. So, what used to happen is if you had W-2 income for a number of years and you paid into Social Security, then you went to work for a government agency, and now you're collecting a public employee retirement account. The the Social Security would be removed. You couldn't collect Social Security and your public employee account, but they've eliminated that. That's now gone. That's now changed. And so, if you are a public employee, you can still collect your Social Security tax because it's taxes that you paid in anyway while you were a private employer or employee. So that's something that's new. There's no tax on tips has been proposed, not not approved yet, but that's been a proposal. Another proposal is no tax on Social Security benefits. And then finally, another proposal is the corporate tax rate. So if you're a domestic manufacturer, rather than a 20% tax rate, it's been proposed to drop the corporate tax rate to 15% if you manufacture locally here in the United States. Another proposal is to make car loan interest deductible on your Schedule A. And then the last one is the creation of an external revenue service. So, in conjunction with the internal revenue service for collecting taxes from payers here in the United States, external revenue service would be to collect foreign revenue and to make sure that foreign workers are paying and remitting taxes that are due to the United States. So here's some bonus material. So if you're finding yourself with a large tax bill and you want and you want ways to reduce your tax your to mitigate the taxes that you potentially have to pay, one of the biggest things to do is income shifting. So income shifting, there's a concept of years. If you want to shift income across years, this one would be to pay your expenses in 2024 and defer your income until 2025. So you're going to spread those years. You're going to bring the expenses forward and push the revenue out. And so that's how you shift your income across years. You can also shift that income across people. And what that would be is, let's say you have children and you have someone that wants to attend college and they're in a lower tax bracket than you. Perhaps you can bring them on as an employee and shift some of the income from your business to your child. And then the other way to shift income is through entities. So if you have one entity, perhaps you put your ownership in that entity into another entity, which allows you to bring in additional deductions and and expenses into the other entity, and spreading that income out across and reducing your overall profitability. Another is harvesting losses. So if you have a large capital gain this year, it might make sense to create some capital losses and get rid of some dog investments that you have and offset capital gains with capital losses. You can also take advantage of the various clean vehicle and clean energy credits that are out there. And the last two are fixed asset purchasing. So if your business is making a lot of income and you're looking for a way to offset it, purchasing a building might be two things. First of all, it's going to give you an asset that you can depreciate and you can write off over time. But secondly, you could purchase that building with another entity. So you have the entity income shifting. So you purchase that building and then rent it back to the corporation as rent. So you're moving the income that direction too. And another is company vehicles is another fixed asset purchase that you can make at the end of the year to help offset income should you need them. So that's just some bonus tax mitigation strategies. So, how can KMK help you with all of this? So, at KMK, we are a full service accounting firm. We work with business, all types of business entities, 1120s, 1120Ss, LLCs, partnerships. We provide accounting, bookkeeping, taxes, financial services, reporting FP&A services, and tax preparation services, of course. We provide consultations to discuss your needs. We can review your current situation, let you know what type of informational returns are required, what type of reporting is required. We can assist you with tax planning strategies. So we offer tax advisory, tax planning. We can guide you through the tax preparation process, and we can even assist you should you get audited. We can assist you with those audits and with the appeals. And finally, we can provide year-round support and advice. We offer substantial discounts on our services for Gust members. So if you're a partner with Gust, we offer this is our tax preparation pricing. It's based on your annual expenses or revenue. And you can see it starts at as low as $349 for a tax return. And same with bookkeeping. Our bookkeeping services for Gust members are discounted, and it's based on your monthly revenue, and it starts as low as $195 a month. I believe, Peter, you said you were going to share this presentation with everybody. And if you share the slides, there's a link here, and this link goes to a site that is the Gust partner page that allows you to request or sign up for tax or accounting services with the Gust discounts.
Awesome. Yeah, and we will send follow-up resources, including the deck and a one-pager on all of this to everybody. Bert, thank you so much. As always, chock full of information. We have some great questions. One thing I want to address quickly before this is, as everyone who has attended this now realizes, taxation is complicated and it is ever changing,
Yeah.
um, which makes it one of those things that is difficult to address for startups that are early and cash strapped. So
Mhm.
as you look at all of this, um, as soon as you can afford to, and there is a ton of value to protect, and you are, making amazing progress, and you have harnessed the rocket ship, getting an awesome tax professional as soon as possible is in your best interest. In reality, a good thing to keep in mind as you approach all of this is your job as a founder is always to balance risk. You should understand the things that come with the greatest financial penalties to you. If your company is the US umbrella for foreign subsidiaries, you definitely need a tax accountant. If you have substantial foreign shareholders, you do not want to miss that filing because it comes with a stiff financial penalty, and you want to start filing your taxes as a corporation each year and making sure that is done. Right? But there are always going to be things that you do not realize, that you do not know you don't know. And part of the service of accountants and lawyers and all of the people that help your business once it really gets rolling is to dot all those I's and cross all those T's and make sure that everything is set up as there's more and more value accruing in the company, particularly around sales tax. If you're a SaaS startup, it can be very intimidating to just confront the fact that you may have to file in all 50 states at some point. But there is a threshold you need to hit before you actually need typically to start
Mhm.
collecting and remitting sales tax. And that threshold is usually somewhere around 100K in gross receipts, right? So there are things in place designed to have these things kick in conjunction with a level of success of your company that makes sense for the burden introduced, right? So materiality and the level of revenue you're generating, um, those are all factors in this stuff. And unfortunately, especially as an early stage founder, you will have to balance your risk profile as you work through stuff like this. Um, all right, into the questions. The first one is from Ludovico, who is asking if he needs to file Form 5472 as, I believe, a founder who is not a U.S. resident and that does not have a U.S. passport?
Yes, yeah, yeah. The 50, it depends. It depends on, so the 5472 is if you are an investor and you own more than 25%. So if you're the founder and you own more than 25% of a US corporation, yes, you need to file 5472. It's just an informational form. So it doesn't create necessarily a tax liability for you. It's more just to let the IRS know that you're not shifting revenues from the United States to another country, and putting information that'd be the subsidiary one. But yes, you do have to file the 5472.
Awesome. Thank you. Next one from Johanna, asking, they have some grant funds that are, the use of those funds is restricted to the scope of the proposed grant. It sounds like some of those funds will actually be spent on R&D and R&D employees, and she
Mhm.
is wondering if those funds would qualify under R&D tax credit potential, even though the funds themselves came from a grant and weren't shouldered directly by the company.
Yes, I have a cohort that does a fantastic job with those that I can put you in touch with. A coworker that does a great job with the Form 6765. But yes, I believe it would count, because because they're an employee of yours. You're paying the taxes. Now, keep in mind that if it's research and development, that does end up being capitalized and amortized, but the R&D tax credits should still be available for those employees.
And
Awesome.
I
Thank
was
you.
going to ask this on the services, Bert, but you guys do provide R&D tax credit support.
Yes, yes, yes. I actually have a specialist that I refer people to, and rather than trusting my judgment, I have a guy that has been doing this for 20 years and is very good at it, and he's very thorough, and he actually prepares the 6765 for us when we file your tax return, and then we add it to the filing when we do it.
Yeah, I threw that in the chat, but basically, like, if you want to pursue the R&D tax credits, just like tax filings that you do for a business, it's generally best to have somebody prep it because it is nuanced and detailed, and there's grants of very different types, and there's all sorts of things. So it's a hard thing to navigate on your own.
Exactly. And that's why when we do the tax returns, I typically will not, because someone will tell me, well, I had this much in taxes and this, and they'll try and give me the numbers, and they'll say, let me put you in touch with my guy. He works with you, he fills out the form, and then I'll add it to your tax return.
Very
Yeah, and I
cool.
think you mentioned this, Bert, in your presentation, but I think important to reinforce the R&D tax credit was kind of Wild West for a while, and
Mhm.
lots of technology facilitated shops popped up to kind of help startups claim this, and they made some pretty bold claims.
Yeah.
Uh, so the requirements here in terms of the case study you need to put together in order to successfully claim these and whether any introspection from the IRS has increased substantially over the years. So if you are going to go this route, make sure you understand what your provider's process is, what type of documentation they provide, and how they deal with potential audit support. All right. Next up, we've got a question from Steve Lindeman. If a consultant has an LLC instead of operating as an individual, do they still get a 1099 NEC?
Yes. An LLC?
Yep.
Yes, yes, yes. But it would be reported under, so when you fill out your W-9, um, you would fill it out with the LLC name and that EIN. So I assume you'd have a separate EIN, because if you use your social security number and then you put an LLC name and it doesn't match, that's going to get rejected by the IRS. So whatever you put on when you complete the W-9, make sure that whatever EIN you're using, whether it's an LLC's EIN or your social security number, that it matches the name in the top line. It can be, Bert Wilson with my social security doing business as LLC, whatever. But yeah, if you have an LLC, if it's a single member LLC in particular, you're going to report that on your Schedule C of your 1040 tax return. If it's a multi-member LLC, Um, there are, it depends. If you're providing services, yes, you're going to get a 1099 NEC, even as an LLC.
All right, great. Next up, from Kristen Mothamore, working on a deferred compensation plan with a contractor who produced work product in 2024. It sounds like the contract for deferred compensation is signed, but there won't actually be an exchange of funds until a future event in 2025. Um, is there an obligation for a 1099 based on the 2024 relationship, or is it when the contractor is actually paid?
1099s are based on when monies are actually transferred, when monies are actually paid. So
Okay.
it'd be in the year that it's paid is when that would be. And then again, for your company tax return, depends on whether you're filing on an accrual or a cash basis. If you're filing on a cash basis, there's nothing to claim. If you're filing on an accrual basis, you can actually write that off today and have it on So anyway, but yes, the a 1099 is based on the year that the monies are paid.
Okay, and I think we've covered this, but Igor asks, do you provide services to early stage pre-revenue startups?
Absolutely. Yeah. Yeah. So yeah, a lot of times pre-revenue, I've worked with people that are pre-revenue and actually have $3 million in expenses and haven't, and they're still pre-revenue. And so they have pretty intensive accounting needs and tax needs, even though they have no revenue yet.
Awesome. All right, we've got a few more in chat. We have Yash Yangid asking about various tax filings and exemptions kept in mind for pre-seed and seed stage funding rounds. Um, there is one thing that you kind of allude to here that isn't necessarily a tax concern, but is a Securities and Exchange Commission concern, um, which is you may have to file or you will have to file an exemption to sell securities when you fundraise. And you will need to determine which exemption you're going to file under to avoid all of the information filings that typically go along with an IPO. Most private companies raise under 506B, which is essentially a private placement. You can't publicly solicit your fundraise. And if you concentrate on only accredited investors, those making above 200K a year in income or with over $1 million in assets, not including their primary residence, that is the easiest. But if you go different routes, there are other exemption filings you may need to do in conjunction with that funding round. Bert, as far as tax implications go for a company raising funds, any insight there?
Hmm. Tax implication? No, not
Yeah,
really.
generally you have money coming into the company, and most of the taxation that would be involved in that equity transaction is going to happen later, right?
Yeah.
An equity investment is made on a long-term basis. Nobody's going to make money or expect to make money off of that investment for 6 to 10 years.
Yeah.
And at that point, they will then likely sell shares in some sort of M&A, or maybe after a lockup period in an IPO. And at that point, when the money actually becomes, or when the shares actually become liquid, then there may be some tax things that will happen.
Mhm.
All right. Does KMK have professionals experienced in biotech startups and accounting requirements when significant funding comes from grant sources?
Yes, actually working with one right now that, that does it, and that's actually the biotech. When I mentioned the one that was pre-revenue and had 3 million in expenses, that was a biotech company that I was
Yeah, I
working
mean, sounds about right.
with. So, but yes,
Also, do you have experience with Delaware companies that have foreign subsidiaries?
yes, yes, absolutely. In fact, we are a Delaware C corporation, and our primary operations are in India.
And just for clarity, one of the reasons that we work with KMK in addition to kind of the stunning reviews that we've gotten about their service, is that they are full service, right? So they have experience with expats, they have experience with multinational corporations, they have experience with all types of business entities, they have experience with venture funds and angel groups, and they also have experience with personal taxes. So
Mhm.
all of that stuff is kind of wrapped up. It is a full service firm that can help you across a lot of the different things that end up getting squished together.
Mhm.
Okay. Margie McFadden asks, if you're a SaaS company, but you only sell to tax exempt organizations like school districts, are there any differences in terms of how you think about your sales tax and other? Um,
Yeah. So if you're selling primarily to tax exempt organizations, of course you want their tax exempt certificate to ensure that they are truly tax exempt and that you can demonstrate they're tax exempt. But keep in mind that with that 100,000 threshold in the various states, that does give you economic nexus. So if you do make a sale to a for-profit company, you now have economic nexus and do have to collect sales tax even if you sell $1,000, because if you've sold $500,000 to tax exempt organizations and 1,000 to a non to a taxable organization, you're going to have to collect and remit because that's giving you economic nexus in that state.
okay, so if I understand correctly, sales to those companies, even though those sales may be tax exempt, the gross receipts would still be affected by those sales and would still establish economic nexus.
Correct.
Okay. Yes, recording and material will be sent out. Is there a Startup Tax 101 document that you can share? Yes, you will receive one from us via email if you haven't already, and we have a great blog post about that as well.
And
Um,
since I live in Colorado, I created one for Colorado specific, but that doesn't do you any good if you don't live in Colorado, because the one I created actually has links to like the Department of Labor, to the family FMLI program. It has links to the Department of Revenue, to the Secretary of State to click on to do the various filings. But
Awesome. We may have to collaborate on one more thoroughly next year, Bert.
okay.
All right, we've got a couple more, and I think that'll take us to time. First one is a Delaware C corporation pre-revenue where the founder is based in New York City. Uh, do they need to file taxes in New York City?
Yes. Yes,
Yes.
that's your physical presence. You have the because again you have physical nexus and economic nexus. So you have physical presence because that's where you or your employees or your business is located, is in New York City. So that creates a filing requirement for you in New York.
Yep. And again, there are a few different taxes, right? So there's okay, you have
Yeah.
physical nexus in New York, which
Yep.
means you should technically foreign register your corporation in New York.
Yep.
New York does not have a large franchise tax burden, but I think you have to pay them something like 25 bucks every 2 years, and
Yeah.
you need to keep your filing up to date.
The
The
one
next,
that's
oh,
the one that's
yeah,
expensive is New Jersey,
yeah,
because New Jersey is based on the number of owners too, and so that some of those filings can get, like if you happen to be an LLC, like a Delaware LLC, but you're a foreign, but you're located, but you have nexus in New Jersey. I think their minimum fee is like $165 per owner or something like that.
yeah, different places can have
Yeah.
wildly different franchise tax burdens. I think Virginia may still be one of the worst. California is pretty tough too,
Yeah.
with a $900 minimum, I
Yep.
think still after year one.
That's correct.
But if you're new and you're a solo founder in New York and you have a Delaware corporation, this is not going to be a crazy burden for you. It will be a filing unless like you're selling a ton into New York already.
Mhm.
Um, you may, because you have physical nexus, you have to collect and remit sales tax because you just have nexus generally. But if you're not making any sales, then you're totally fine. And you may have to file your corporate income taxes in New York. But again, as a small startup that does not have a lot of complications and expenses and revenue, that is not going to be a crazy thing. So you do have those three separate pieces that you need to watch out for, but none of them are insanely complicated or burdensome. Okay, and Blake Hess is our final question. Okay. Blake, I'm going to put you in touch with Bert via email on this one because I think it is complicated enough that we aren't going to be able to cover it in the time that we have. But I will put you in touch with Bert and we can get a consultation going so you can explore that.
And Blake's in mission control too. So you
Yes.
should already have access to all those links, Blake.
Oh, and we have one that came in under the wire. What's the advantage of having a Delaware C Corp versus an NV C Corp? We'll try to answer very, very quickly. The primary advantage is the mountain of precedent that has been set in how the Delaware Corporate Code will be applied in actual case law, giving everybody confidence in not just what the law says, but how it will be interpreted and applied to actual business dealings. There are still other states that are vying to outcompete Delaware as the home of the largest set of companies in the United States. Delaware is still holding on despite Elon Musk's best efforts. Uh,
I was going to
so
mention that.
Delaware is still the way to go and largely considered the way to go, despite the FUD that you will read online. So pick carefully. It may have some impact on your funding. It may not if all of your investors are in Nevada and are focused on investing in and building up Nevada business.
Yeah, I've had businesses that were incorporated in other states, and when they went to get funding, they were required to be a Delaware C corp because the some of the certain investors require you to be Delaware C corp.
Yep. And most institutional VCs will. Um, Awesome. Well, we are just a little bit over time. Bert, thank you for the 2 minutes extra. As always, thank you for being here and sharing all of this with us. We will send out follow-up materials, including the deck and some Q&A and some other one-pagers. Keep on the lookout from emails from us with more Tax 101 resources. Mission Control folks, we will likely have a dedicated Q&A within Mission Control to dive deeper in some of this stuff coming up. We will keep you up to date on that. And if you have tax accounting issues, bookkeeping issues, get in touch with KMK. If you need some help wrangling your corporate structure, your incorporation, your equity management, 83Bs, QSBS, franchise tax filings, come find us at Gus Launch and we will make at least 50% of your life easier, and KMK will take care of the rest. Thank you, everybody. We'll see you soon. Bert, thanks again for your time.
Thanks, Peter.
See everybody.